What's going on, everyone? It's Griffin here, and I hope you're all having a fantastic week so far. Now, in today's video, I wanted to do something that I've been meaning to get around to for quite some time now, and since we're literally in November with 2022 right around the corner, what better time than to do one of these TSX master stock list videos moving into the new year. And in this video, we're going to be speaking about some companies I either have in my portfolio right now or that I have an eye on in different categories of companies like growth stocks, dividend stocks, as well as even some exchange traded funds. So we'll be covering upwards of 20 different positions, all of which trade in Canada though on the Toronto Stock Exchange, TSX for short. And obviously for this reason, we're not going to go into full detail and depth about each individual company. That would take like 3 hours to do, but because there's a lot less options in the Canadian market, I wanted to go through some of my top stocks that I'm watching and that I'm holding in the Canadian markets. As a Canadian investor myself, quite a few of the stocks that I hold in my portfolio are therefore Canadian equities, and typically US stocks can steal the show though when we're talking about the stock market. Not in today's video though, so let's just get right into it. And if at any point in today's video you're enjoying the content, make sure to smash the like button. It really helps the channel out. It's been pretty tough out here with views as a finance creator. So on that note, let's get right into it, starting with growth stocks. Okay, so stock number one here, and one of my favorite stocks that trades in the Canadian market, we have GOEASY, ticker symbol GSY, which has seen a fantastic year, up around 180%, even considering the recent consolidation following its all-time high share price of $218. So it's come down roughly 11%, and I honestly think that's fair considering how much momentum the stock was picking up. From its bottom price point in March 2020 of under $30 a share, which is pretty crazy to think, but some investors could have even seen over a 600% price increase on a company that's essentially an alternative lender. And right now at a price to earnings ratio of just under 15x, this brings the stock back down a bit more towards a more reasonable valuation. Now, in one of my TFSAs, I've been holding a GOEASY stock for the better part of a year at an average price point of $96 per share. And even considering this recent consolidation, that position is still up over 100% at the time that I'm making this video, which is on Sunday the 31st. And by this time it may have changed a little bit because I think the video is going to be released on Wednesday. If we consider how this company's been performing financially though over the past 12 months, it's pretty evident as to why the market has taken a liking to GOEASY, with both top as well as bottom line figures increasing dramatically year over year. I would also tend to believe that with interest rates expected to be increasing throughout the course of 2022, this will most likely be beneficial for a company like GOEASY that lends out money. And even considering the pretty substantial rally that we saw throughout the course of 2021 for this stock, we're still looking at average analyst estimates over the next 12 months of around $210 per share, which would show roughly 8.5% upside from the stock's price right now. Finally, what I like about GOEASY stock, and as to why I hold it in my portfolio, they have a really steady and consistent dividend, even though the yield is in the low 1% range. Still better than nothing. Moving on to growth stock number two here, we have a LIGHTSPEED Commerce, ticker symbol LSPD, again on the Toronto Stock Exchange. And although lately we've been seeing some shaky movement for LIGHTSPEED amidst the allegations towards the company, it remains a part of my portfolio for now after having sold off a smaller chunk of my shares back in September at an average price point of $148. I had spoken about this briefly in a past video, but I chose to trim off a small portion of my LIGHTSPEED shares back in September when it had reached close to those all-time highs, pretty much just because I was seeing a lot of euphoria around LIGHTSPEED without any concrete new positive financial information or even just business information coming out about the company. So this was kind of just some luck that it would be right before allegations that of course I had no news or idea would be coming out, which ultimately led to that relatively steep consolidation that we're in right now. For now though, my position in LIGHTSPEED is still up around 185% at the time of filming this video. And as mentioned in that previous video, I'm kind of just planning on holding onto my LIGHTSPEED shares for the coming quarter or maybe 2 quarters as we get more financial information about the company being released, and then also some more news and information about these allegations towards LIGHTSPEED. For now though, the stock is currently down around 26% from its all-time high of $165 per share and has since been trading in the low $100 to $110 per share range. The reason why I'm including LIGHTSPEED Commerce in today's master list video though is because, well, I still do hold quite a few shares in a couple of my investment accounts, and so this is something that I wanted to speak about. However, I'm not necessarily as bullish on LIGHTSPEED as I was a year back when I was first speaking about this stock and the company that was seeing tremendous momentum and growth. Right now, this company is still very far away from any form of profitability whatsoever, and their operating cash flows are down significantly. What's more is that to finance their growth of operations, they're diluting shareholders quite heavily. Over the past year, we've seen 20% shareholder dilution. So although LIGHTSPEED does appear to be growing their top line aggressively, well, I still think that considering everything that's going on for this company, the stock is still trading at a relatively rich valuation. And personally, I'm most likely just going to be holding on to the shares I have right now and seeing how this plays out over the coming quarters. I kind of doubt that we're going to see multiple double-digit growth in terms of the share price over the course of 2022. That said, though, currently the analyst estimates for this stock are at around an average of $150 per share, which would represent 23% upside with a high even of $195 per share. I personally kind of doubt we'll see that over the coming 12 months, but who knows? Growth stock number 3 for today's video is Shopify, ticker symbol SHOP, which we haven't spoken about in quite some time on the channel, but remains a part of my portfolio for now, with a stock that's actually managed to maintain most of its gains over the past year. So right now, Shopify stock trades for around $1,800 a share in the Canadian markets, which is up 50% this past year, despite a bit of volatility, and for the better part of the past 6 months now, has been trading sideways. So could this stock continue to perform as it has previously over the course of 2022? That's the question. Well, for one thing, Shopify is a company that's seen incredible financial growth over the past couple of years, which of course has also contributed to the share price following suit, but has also resulted in the company's stock becoming quite richly valued. The only reason why we're seeing EPS of 53 right now though for Shopify is because of their recent other income, which isn't true income from operations. So that's why the company has a forward price to earnings ratio back up well above 200x. What's going for this company though is the fact that they have a massive amount of cash on hand at $7.5 billion, which is pretty incredible for a tech stock like this. Pretty sure their current ratio is above 10 right now. And they're also a pure e-commerce company, which is fully benefiting from the growth right now and over the next decade of e-commerce as a whole. Shopify has also stated in their most recent forward-looking information that they expect the fourth quarter to contribute the largest share of full year revenue for 2021, and they also go on to say that we continue to expect rapid growth in gross profit dollars in 2021 and plan to continue reinvesting back into our business as aggressively as we can, with the year-over-year growth in operating expenses accelerating slightly in the fourth quarter. So the way I see things right now for Shopify is I think this upcoming fourth quarter of 2021 is probably going to be their best ever quarter financially, and over the course of 2022, I think Shopify will be able to increase their top line by an additional 30% year over year. That's something I could definitely see. However, right now, the reality of things is that the stock does still remain quite pricey from a valuation standpoint, but over the course of 2022, it would not surprise me whatsoever if this stock exceeds $2,000 Canadian per share. Finally, analyst estimates for Shopify stock as of right now are relatively split at a hold and a buy, but the average price over the next 12 months is around $2,100 per share, which would represent roughly a 16.5% upside for the stock. And even the lowest target is actually not too much of a consolidation, with the highest price point just under $2,500 per share. I think we'll probably see the stock averaging anywhere between that average and high target. All right, moving into growth stock number 4 now, and I think we're gonna have to go a little bit quicker if we don't want this video to be 2 hours long, but we have Well Health Technologies, ticker symbol WELL, and this stock is currently trading for roughly $6.50 per share. This is a stock that's seen a rough past 12 months and is actually down over the past year as a whole, and down around 25% from its all-time highs. So let's see what's going on and if there's any silver lining for Well Health as of right now. I first spoke about this company back near the beginning of 2020 as it was gaining insane momentum, and this was also in parallel to other peers in the industry that were also appreciating quite nicely in the entire telemedicine space as a whole. And although granted, WELL Health hasn't done much over the past year, well, it still managed to retain quite a bit more of its value from its all-time highs than other peers in the industry like TDOC that still remains down around 50% at this point. This, I would say, is mostly because the company has actually managed to continue increasing their top line, mostly through the continued growth of their core business, but then also through strategic acquisitions, both of which should continue to sustain their growth momentum. And by the way, just because I haven't spoken about it in a while doesn't mean that my opinion has changed around telemedicine, where I still very much believe over the next 5 to 10 years there's going to be a significant increase in demand and need for telemedicine. In fact, through to the year 2030, which by the way is going to come a lot quicker than it might seem, it's expected that telemedicine will represent a $450 billion market worldwide. Finally, WELL Health Technologies has delivered positive adjusted EBITDA figures over the past 3 quarters, and they're expecting this trend to sustain, which is definitely a step in the right direction. The company also projects to generate an annualized revenue and adjusted EBITDA run rate of $400 million and $100 million respectively, which would be a 500% increase in top line year over year from 2020. Finally, let's take a look at analyst estimates for WELL Health Technologies as it stands right now. So the average analyst estimate is at around $12.60 per share, which based on how the stock's been trending over the past year might be hard to believe, but the company is definitely in the right direction from a growth standpoint. And even the lowest price target right here is just above $10 a share. Speaking of telemedicine, the fifth and next growth stock in today's video, we just have to speak about it. It is CLOUDMD, ticker symbol DOCV, which has been, let's be real, an absolute disaster over the past year. There's really no other way of putting it at this point, unfortunately. In fact, just from holding, I'm actually now even down on my average position, but I'd still add it to my watch list at the very least as it continues selling off if this isn't a company that you're holding. The stock's down 50% over the past year and has not ever been able to maintain some upwards momentum for more than only a couple of days. That being said, the company has been posting relatively significant top-line growth figures over the past year, mainly through acquisitions, that is, but ever since that last round of share dilution and the CEO selling off a substantial amount of shares, this seems to have had investor confidence at an all-time low right now for this company, at least until we see some upcoming positive financial information, which it has been a while. At this point, I've just been holding on to the shares of this company that I have for now, as I've been waiting for the company's projected revenue run rate for the 2021 year to actually start materializing in their financial figures. So for the time being, there isn't really much to analyze from a financial standpoint, and they're expected to be posting their Q3 figures near the end of November. So we'll see how this plays out and if this does have a positive impact on the share price. Until then, though, there aren't any signs whatsoever really of any type of reversal for this stock, and following it down into the trenches isn't necessarily something that I would recommend in terms of averaging down indefinitely at this point. Moving into stock number 6 now, this is a company that I only purchased a tiny amount of shares in a couple months back in the public stock market portfolio that we were playing around with. The company in question is Storage Vault Canada, ticker symbol SVI, which trades right now for around $6.20 per share. Now, this stock has actually seen a really nice past year, up 85% over the past 12 months and 50% year to date. But for anyone who's holding this stock, I don't really expect to see the same type of returns through to the rest of the year and beyond in 2022. I do definitely like the self-storage business model though, and do believe that there's going to be an increased need for self-storage as well as this company's services over the coming years. And Storage Vault Canada right now does have a strong underlying business that's continuing to grow through acquisitions. When looking at this company's financial growth, they've managed to steadily increase their top line year over year since 2017, and this should only grow larger as the company expands further, like with their most recent $130 million acquisition. So overall, SVI will undoubtedly continue to increase their total leasable area over the coming years, which in turn will also have a significant impact on their top line growth and could also contribute to the increased and sustained momentum that this stock price has been seeing. Keep in mind though that based on financial figures that I'm seeing right now, as well as any business developments, I don't expect to see SVI stock seeing any type of growth in the realms of what we saw across 2021 in that 85% range. But if you want exposure to an alternative style company that has gives you exposure in your portfolio exposure to self-storage, SVI could definitely be a viable option. Stock number 7 here is Park Lawn Corporation, ticker symbol PLC, which trades for $37 a share and has also seen extremely nice movement this past year, up around 30% over the past 12 months, but has been quite flat since August. This is a company that purchases and holds funeral homes as well as cemeteries across North America, which has been a tremendous business financially over the past couple of years for PLC. Now, Park Lawn Corporation is expected to post their Q3 figures on November 11th, which is kind of sinister considering the fact that here in Canada, November 11th is Remembrance Day. So yeah, considering the nature of this company, kind of interesting. But regardless, I'm expecting to see around $90 million in top line for PLC in this past quarter. But even considering PLC's share price, which again has risen quite a bit over the past year, the value is still relatively quite nice. So at face value, a PE of 38 does seem quite high and usually is quite high. But if we compare this to this company's past PE ratios that it's commended, it's actually nothing out of the ordinary. In fact, it's among the lowest the company has seen since 2017. And another thing to consider is that the forward price to earnings is also significantly lower at 23x. Another thing that's interesting about PLC stock is that they have a monthly distributed dividend with a yield that is quite low at around 1.24%. So nothing major to call it a real dividend stock, but there is still a small dividend. For the rest of the year though, and entering into 2022, I definitely think we could see PLC stock reach the $45 per share range, and analysts tend to agree with me here with an average of around $45 per share, with the lowest being $42 per share. So this would represent roughly a 22% upside over the next 12 months. Moving into the next growth stock, I'm not even sure which one we're at this point, but it is Green Lane Renewables, ticker symbol GRN.TO. And this is a company that I also have in my portfolio as of right now. Everything we've just looked at, I do have in my portfolio. And moving into 2022, there's definitely some interesting stuff to take a look at and consider for this company. First of all, the stock is down hard from its all-time highs that it reached back in February, down around 50% as of right now. And over this course of time, it has seen some peaks and valleys, appreciating by 50% and then consolidating back down quite dramatically. So right now though, the stock price is trading at around $1.50 per share. By the way, for those of you who may not know what a GRN is and what they do, this is a company that develops and then manufactures and sells biogas upgrading systems pretty much worldwide at this point. The main issue with GRN as it stands right now though is that the company is still highly unprofitable, and based on analyst estimates for the growth of this company's earnings per share, they're estimating that for the entire 2021 calendar year, the company is going to once again post a significant loss, but then they should be turning into slight profitability, that is, but over the course of 2022, if the company is able to maintain their relatively high year-over-year growth in the waters of 60%, which should be doable for this company as it stands right now though, because they have no debt on their balance sheet whatsoever, and they're just fueling their growth through the financing from their share issuances. Please keep in mind though that with Green Lane Renewables, this is still a penny stock and therefore does inherently come with higher levels of risk and volatility, especially considering the nature of the company right now. So it is growing significantly year over year from a top line standpoint and should be turning into profitability as of next year. But keep in mind that this does have a higher level of volatility than the overall market right now. I'm still pretty bullish though on this company and the future growth of the stock price, and analyst estimates have an average price target of $3.17 per share over the next 12 months, which would represent above a 110% upside. Make sure to let me know what your thoughts are on Green Lane Renewables and everything else we've looked at previously in this video down in the comments. I'd love to know. And also let me know what some of the companies that you have in your TSX master list are down once again in the comments. In fact, there's a couple of small cap companies that quite a few of you in the audience have asked me to speak about, but I currently do not hold them in my portfolio. They're on my watch list and I'm keeping an eye on them. These include Fobi, Nuvei, as well as Hive Blockchain. If you want me to make a full standalone video about these, let me know down in the comments and I might get to it. And actually, last but not least, I almost forgot for the growth stocks. We also have in my portfolio TruLeaf Cannabis, which granted has really not been a growth stock over the past year. It is down hard. Ticker symbol TRUL, by the way, though. So let's take a look at the stock chart right now. As we can see here, the stock price currently sits at around $31 per share, which is pretty insane to think that it hit a 52-week high of just under $70 per share. So in fact, it is actually down roughly over 50% at this point, which based on the underlying financial growth of this company, ultimately really doesn't make all too much sense in my view. I've had people asking, and yes, for now, I am still just holding on to my shares. With that said, I'm down significantly on my position, down I think around an average of 15-20%, and I'm not adding more or lowering my cost basis because I have just purchased quite a bit of this stock and it represents a relatively large percent of my portfolio, but I am still bullish and my convictions remain the same for the future growth of this company. The main reason why we've been seeing the stock consolidating down so much though over the past year, there have been quite a bit of negative headwinds, kind of like Facebook in a sense, where the CEO as well as her husband have been in the media crossfire based on some scandal allegations and some controversy. So that has definitely had a negative impact on overall investor sentiment towards TruLeaf Cannabis. Truth be told, I'm extremely surprised to see this stock trading in the low $30 per share range. I did not think we would be seeing this. However, again, I just try to stick to the underlying financial growth of a company. And we're seeing this company growing by leaps and bounds quarter over quarter, both from a top line as well as a bottom line standpoint. So we're seeing in the last reported quarter, which was Q2 2021, they reported revenues just above 215 million and net income of just above $40 million. This is definitely a company that's in the right direction financially, as well as the growth and expansion of their business operations across the United States. So yeah, I'm not really going to dive deeper into financial analysis of TruLeaf since I recently did so on my channel. I'll leave a link down in the description to that video. And if we take a look at analyst estimates, they're also extremely bullish on TruLeaf Cannabis Corp at an average price target over the next 12 months of $81 per share. Now, of course, it's difficult as an investor to continue seeing your position dropping down further and further and further. And at some point, kind of like Corsair Gaming, well, you can have conviction in a company and it still hurts. But for now, I'm just trying to hold on. I've averaged down quite a bit and I'm just going to hold on because I do have conviction in a turnaround for this company over the next couple of years. But ultimately, we'll have to see how it plays out. At this point in the video, I'd like to thank today's video sponsor, which actually there isn't a video sponsor, so I'm going to be sponsoring my own video today. Make sure to check out the links down in the description for my full stock market investing course. This is a course I developed over the course of around a year, no pun intended there actually, but this course has around 60 video lectures where you'll learn everything you need to know about stock market investing, the basics, the fundamentals, navigating the market, and then everything also that you need to craft your own portfolio suitable for your needs as an investor. So yeah, check out the link down below for access to that course. And now let's get back to the master list. All right, so we've made it through the growth stocks. This video is going to be a lot longer than I was initially anticipating, but we're now going to be speaking about some dividend stocks that are in my personal TSX master list. These might be quite familiar to you because they really are the companies I believe in the most, hold in my portfolio, and I've spoken about in previous Canadian dividend stock videos. But nonetheless, let's take a look at some of these dividend stocks. The first two dividend stocks here are real estate investment trusts, first one being Granite REIT, and the second one being Northwest Healthcare Properties, ticker symbol NWH.UN, since this is a trust. Let's start with Granite REIT though, ticker symbol GRT.UN, which some of you might be familiar with as this is a real estate investment trust that I've spoken about in the past on the channel as it's one of my favorites. So most of you might know that I'm actually a real estate investor myself, physical real estate that is. However, I don't have any exposure to industrial properties. And this is exactly what Granite provides my portfolio, as this is a trust that purchases and holds investment properties that operate in the industrial real estate sector, including warehouses, industrial centers, as well as logistics centers with clients such as Amazon and other large industrial clients. One of the reasons why I like this company so much is because they have an extremely low rate of tenant turnover, as well as an extremely low rate of missing rental payments, that is, from their tenants. In fact, over the past year and during the pandemic, they never missed one single rental payment from any of their tenants. The company has also seen nice growth in funds from operation over the past couple of years and has been significantly expanding their footprint in terms of purchasing new industrial properties for their portfolio. So currently, Granite REIT has just surpassed $100 per share on the TSX, and over the past year, it has been a great year for this company, considering that it's a dividend stock, up around 33.5% over the past 12 months, and year to date, it is up around 31%. The company also has a nice dividend yield of 2.99% at the time of filming this video, making this a relatively nice dividend stock considering the appreciation that their shares have also seen over the past year. So yes, GRT.UN has been seeing quite a bit of growth over the past year, as well as since the March 2020 lows, but nonetheless, I think that considering the momentum it's been seeing, as well as the financial growth quarter over quarter that it is repeatedly having, I could continue seeing this stock appreciate by another 10 to maybe even 20% over the course of 2022, while also providing a nice dividend to your portfolio. Now, that second real estate investment trust that I was speaking about is Northwest Healthcare Properties, ticker symbol NWH.UN. The .UN is because it is a trust. Now, this is a company that operates in more of the medical and healthcare real estate sectors. So GRT.UN was more operating in the industrial sector, versus this is focusing on healthcare properties, which is another facet of real estate that's going to be experiencing significant levels of growth and need over the coming decade. Now, other than the fact that I think there's going to be an increased need and demand for this company's properties over the next decade, another reason why I'm including it in this dividend section to watch over the course of 2022 is because, well, this company offers a very nice 6.2% dividend yield at the current share price of around $13.30 a share. I don't necessarily think that this is a absolute buy in terms of anything for appreciation of share price over the coming year. However, this really is more of a dividend play at that nice 6% dividend yield as it stands right now. And regarding the sustainability of this company's dividend distributions, well, although they aren't increasing year over year their distributions, which is usually always something that I like to see and recommend for a good dividend stock, but in this case, they have remained constant in terms of their distribution amount. And for this reason, though, with the share price fluctuation, this has also impacted the fluctuation of their yield over time since around 2017. Moving into the third dividend stock that of course is going to appear on my TSX master list, we have TELUS, which is one of the largest and only really telecommunication companies in Canada. The ticker symbol for TELUS is T, of course, on the Toronto Stock Exchange. And as of right now, the stock is trading at a share price of $28.40. Now, TELUS is a company that I've spoken about a lot on my channel. So again, I'm not going to dive into a lot of detail around it, but this is a company that has a massive customer base. And so for this reason, they have significant recurring income that is quite steady, even though it's not growing significantly year over year. In their last reported quarter, TELUS reported a top line of just above 400 billion, 4 billion, I should say, not 400 billion. And their net income was around 335 million. Now, analysts are expecting that in Q3, which should be posted over the coming weeks, they're expecting earnings growth, which is definitely positive. And ultimately, though, this is a dividend stock. And what we care about most is sustained dividend payments over time and those increased dividend payments. So we can see that right now their forward dividend yield is 4.46%, which is very nice for any dividend portfolio. And they've also sustained their payments for over 10 years at this point. So yeah, as mentioned though, the stock is currently trading for right around $28.40 per share, which is actually down around 5% from its all-time high that it reached back in September. Telesto is the type of stock that you can consistently buy into over time, as this is the type of company that is continuing to grow despite the fact that they're not seeing massive levels of year-over-year growth. With that said, they are expanding into the 5G networks, which should also help increase this company's growth over the coming decade. The next two Canadian dividend stocks that are in this TSX master list are going to be bank stocks. And of course, you probably know what I'm about to speak of. TD Bank as well as Royal Bank of Canada are really the two go-to bank stocks that I have for my dividend portfolio. Starting with TD Bank, this has been my go-to bank stock for the better part of 3 years at this point, and currently the stock's trading for right around $89.80 per share, which is pretty much at all-time highs, and currently the stock has a dividend yield of 3.5%. TD Bank, though, is pretty much a bulletproof Canadian dividend stock. That is, they have a 10-year dividend growth streak at this point, and their dividend payout ratio is very low at around 35%. That second Canadian bank stock that I was speaking about is Royal Bank of Canada, ticker symbol RY on the TSX, and currently this stock is trading for around $104 per share, which was down around 2% in the past day. But this is also a solid Canadian dividend stock with a current dividend yield of 3.35%. Fun fact, Royal Bank of Canada was actually the largest Canadian bank in terms of market cap for quite some time, with TD Bank trailing behind it. And over the past year, TD Bank has actually managed to surpass the total market cap of Royal Bank of Canada. But RBC is still a very solid Canadian bank stock that has a nice dividend yield and a dividend growth streak of also 10 years, just like TD Bank. And their dividend payout ratio is also quite low at 41%. Moving on to the next two dividend stocks in today's Canadian master list video, we have two utility stocks. The first one being Fortis Incorporated and the second one being Capital Power. Starting with Fortis Incorporated, this is one of Canada's largest utility providers and is also one of Canada's longest distributing dividend stocks at a streak of over 45 years, which is really impressive. So as of right now, the stock is trading for right around $55 per share, and it's had some rocky trading over the past 2 years, but nonetheless, right now the dividend yield sits at 3.88%. Fortis Incorporated also has a nice dividend payout ratio of right around 55%, giving it a comfortable dividend distribution considering its net income. The thing about an established utility company like Fortis is the fact that they also have steady recurring revenue. So again, for this type of dividend stock, year-over-year revenue growth and net income growth isn't going to be anything monumental, but it is steady and consistent, which is what we want to see for a nice dividend play. Moving into that second Canadian dividend utility stock, we have Capital Power, ticker symbol CPX, and this stock currently trades for right around $40.65 per share, and actually it is down significantly over the past month or so, down around $4 per share. Now, over the past 2 quarters, Capital Power has actually seen a significant decline in top line. However, in their recently reported third quarter, they've managed to regain some financial foothold and have ample levels of cash flows to sustain the momentum with their dividend payments over time. Now, of course, there are many more quality dividend stocks that we could have included in today's Canadian TSX master list video. So for that reason, I'm going to include another video right here, a link to another video that is where you can see some other really great quality dividend stocks and a much further analysis into why I believe these are quality dividend stocks to hold in a portfolio. At this point, I really hope you're enjoying the video. If you are, make sure to smash the like button and subscribe. Now, in the last section, I was going to go over a couple exchange traded funds that I wanted to include in today's master list video, but honestly, I think this video is just way too long. I've been filming for like 3 hours at this point, and I really think that it would be more pertinent to actually just go over a full standalone video about some great exchange traded funds moving into 2022. So that's what I'm going to do. I really hope you enjoyed today's video. If you did, again, make sure to smash the like button and check out all of the other content that's currently on my YouTube channel. We have a lot covering dividend stocks, growth stocks, exchange traded funds, as well as even real estate if that's something that interests you, and lifestyle finance. So on that note, thanks a lot for watching today's full TSX master list video. I hope you enjoyed it, and I will see you in the next one.